All right, we have more changes unfolding in the U.S. economy and the U.S. housing market. Changes that have brand new numbers coming out of the New York Federal Reserve released yesterday, showing an early preview of what we may be able to expect to see in next month's SLOOS report, which is the most important report, in my opinion, for the Fed during this period, the current cycle that we're in. And we'll also look at Zillow's brand new August data, just released a few days ago, synced into our database. And let me tell you, when I first opened our Zillow home value map, I was a bit taken aback. I had to double check and make sure that there wasn't some kind of error or some problem with the data feed. Well, there wasn't. Some big month-over-month changes just happened in a couple of markets. But before we get started, I just wanted to say how much I appreciate you all. I was going to make a video like this when we hit 100,000 subscribers, but I think now is as good a time as any to just say thank you for supporting the channel. First video I posted was back on June 23rd, 2022, so around 14 months ago. And I've left those early videos public purposely, as cringeworthy as they are. The point of this has to always been to just share my thoughts, my perspective on what's happening, show you the data that I happen to have access to, and give my point of view on it. So YouTube's been great in that regard. Again, thank you for the support. All right, so the Fed, folks, the New York Federal Reserve just conducted their latest survey of consumer expectations. This survey was for the month of August, and it gives us an early glimpse into just how hard it's gotten to obtain credit of any kind, whether it be a consumer loan, a line of credit for your business, whatever it may be. Basically, all debt products are harder to qualify for right now. But just, how hard is it really? How much tighter has it actually gotten? Well, the best way to see this is with the Fed's SLOOS report, the Senior Loan Officer Opinion Survey, a questionnaire that they send out once a quarter to lenders throughout the country, asking them if they've tightened or loosened their credit standards, meaning making it easier or more difficult to qualify for a loan. And why do we care about this? Because every time lenders stop lending, a recession follows shortly thereafter. You can see it on this chart. The dark shaded areas are recessionary periods. Right now, we have data up to last quarter, so Q2. What we want to know is, have the banks continued this process? How much more restrictive have they made it? But since the SLOOS is only conducted quarterly, it's hard to get any real-time insight. You can look at the Fed's weekly loan numbers that they put out, but that just shows loan activity, not the structural changes that banks are making to their qualification process, which is why this new report released by the New York Fed could be useful. It can help us get a sense, a glimpse of what we can expect to see when they release the SLOOS next month. So here's what they published on their website, a press release on the results of the report. And let's just say they are bad, folks, not what you want to see if you're hoping for economic growth. Here's what they write. Perceptions about current credit conditions and expectations about future conditions both deteriorated. Households' perceptions about their current financial situations and expectations for the future also deteriorated. Now, real quick, this survey of consumer expectations, it's conducted similarly to how they do the SLOOS, where they send out a questionnaire, in this case to around 1,300 people, heads of households though, asking them specific questions, and then they resend that questionnaire to those same 1,300 people each month to gauge how this same sample group's perceptions change over time. And for the questions on credit specifically, they are bad. Here's what they say. Perceptions of credit access compared to a year ago deteriorated in August, with the share of households reporting it is harder to obtain credit today than it was 1 year ago, hitting a new series high. Expectations for future credit availability also deteriorated in August, with the share of respondents expecting it will be harder to obtain credit in the year ahead also increasing. Now, again, this is a survey, right? We won't know the real numbers, how much the banks are really clamping down until the Fed puts out the SLOOS next month. But what we do know, based on the last time that they released this report, is that the majority of banks plan to continue tightening lending standards for the rest of this year and into 2024, meaning making it harder, more difficult to get a loan, access to credit, which is the bread and butter of the U.S. economy. Almost all businesses rely on credit in some form or fashion. Individual consumers rely on their credit cards for discretionary type spending. So yeah, it is a real problem, and it's all part of the plan, folks. We've heard many Fed members, even Jerome Powell himself, talk about this, how lenders tightening credit standards can have the same effect as rate hikes can. Here's Jay Powell talking about this a few months ago. Take a listen to this.
Thank you. Colby Smith with the Financial Times. At the March meeting, you mentioned that tightening of credit conditions from the recent bank stress could be equal to one or more rate increases. So given developments since then, how has your estimate changed?
Yeah, I think I followed that up by saying it's quite impossible to have a precise estimate of the words to that effect. But in principle, that's the idea. You know, when we've been raising interest rates, and that raises the price of credit, and that, in a sense, restricts credit in the economy, working through the price mechanism. And you know, when banks raise their credit standards, that can also make credit tighter in a kind of broadly similar way. It isn't possible to make a kind of clean translation between one and the other, although firms are trying that, and you know, we're trying it. But ultimately, we have to be honest and humble about our ability to make a precise assessment. So it does complicate the task of achieving, you know, a sufficiently restrictive stance. But I think conceptually, though, we think that interest rates in principle, we won't have to raise rates quite as high as we would have had this not happened. The extent of that is so hard to predict because we don't know how persistent these effects will be. We don't know how large they'll be and how long they'll take to be transmitted. But that's what we'll be watching carefully to find out.
And look, we're already seeing the downstream effects of this playing out in the most interest rate sensitive sectors of the economy, like CRE, for example, commercial real estate. Look how difficult it's already gotten for CRE investors. This is Q2's SLOOS report. Virtually as tight today as it was during the worst days of the great financial crisis. So this clamping down by lenders, along with these higher rates, really is a recipe for disaster, and why we're seeing so many defaults on big CRE projects. Now, it's not having the same effect on the housing market, only a small, limited effect so far. We could see it here. Mortgages are beginning to get more difficult to obtain, but again, the difference is that residential mortgages are sponsored by the GSEs. Not all of them, but a good majority are. But here's the thing, even with all that government backing and the shortage of available inventory, how so few homes are available for sale right now, the housing market is still taking a beating in specific markets. Granted, on a national level, home prices ticked up to positive territory year over year, but Zillow just released their August numbers. Take a look at this. What we're looking at is Snapforce Real Estate Insights, an app that lets you visualize the housing market data from the big three real estate brokerages in a digestible way. So instead of looking at spreadsheets, you could see it on our interactive map. So what we normally look at in these housing videos is Zillow's home value index data set. If you ever browse Zillow, I'm sure you've seen their Zestimate number. Now, the redder a county is, the more home values have fallen. The bluer a county is, the more home values have risen in said county. This is year over year. So from August 2022 to August 2023, basically as up to date as you're going to get. And what's interesting to me is how if you take a big picture view, right, the market is basically flat, barely positive, and that's with these obnoxiously low quantity of homes for sale. You'd think with so few active listings, we'd see prices keep moving much higher like we did over the last few years. But we're not. We're seeing prices, like you see on this map, staying flat or going negative in parts of the country. And the reason is because people can't afford to buy a house. So what would happen if we had double the number of homes for sale? Would prices go up or would they go down? Well, I think they'd go down. Basic market fundamentals, supply and demand. Well, look how low inventory is right now. We have 600,000 houses, or a 600,000 house deficit right now. We had 1.2 million on average pre-pandemic versus 600,000 currently. This gap will normalize eventually. It always does. The quickest way for that to happen would be a spike in unemployment. I spoke more about this a few videos ago. So if you're priced out of the market right now, just know this won't last forever. All right, let's jump back to the map real quick. I'll cover a couple of the counties requested from the last housing video that we did. All right, if we drill down locally by county or even by zip code, we can see there are huge pockets here of markets that have home prices falling. Texas stands out like a sore thumb, albeit a lot of these counties have very few inventory, very little inventory, very tiny counties. If we hover over them, we can see exactly what's happening. So down here in the western part of the state, this big pocket right here, this big red pocket, I don't know, take Brewster County, very small, just 73 active listings right now, but home prices are continuing to fall. Typical house in Brewster County now down 9.5% since last year. But if we jump over to Austin, Texas now down 13% from August of last year, but still well over pre-pandemic prices. Typical Austin home now sells for $533,000, still 50% over August 2019, 60% over August 2017 prices. And wow, 153% higher today than they were at the peak of the '06 housing bubble. What about Dallas-Fort Worth metro? A couple of requests for this area. Let's start with Dallas County, only down 2% from last year, still 50% over August 2019 prices. But if we go next door to Tarrant County, prices are now down 4%. If we go to the east, in Kaufman County, down 7%. Prices here have actually been falling continuously month over month through the spring selling season even. Let's jump out to Salt Lake City, Utah. A number of requests for Salt Lake City. What do we have here? Down 5.5% since August of last year. Currently 2,800 active listings. Still 50% over August 2019, 72% over August 2017 prices. All right, if you enjoyed this video, got something out of it, press the like button. If you didn't, that's all right too. Press the dislike button. Either way, I appreciate you watching.